Wisetech was quote unquote raided by the Australian Federal Police and ASIC, and it's alleged insider trading.
Do you remember your Rask event at the State Library?
Yeah.
You know who said they'd invest in uranium?
Lee Matthews.
Lee Matthews.
Nuclear might well be the base load alternative. It seems logical to me to think about. I mean, anyway, that's so maybe something in the uranium or the energy or the nuclear energy sector might be my pun.
This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing. Drew Meredith, you got a striped shirt on today. How you doing?
Green on green, yep.
Green on green, yeah.
Just to show you what my portfolio is looking like today.
Oh, wowza.
Yeah, all green.
The everything portfolio is now up 19.36% since January. How do you feel?
I've actually stopped looking. Usually I look at it every day and send you the eyes thing when I'm losing or you're losing. But yeah, it feels great. Just sit right in my way on top. I did not expect to be... now, let's not crow too early like you did.
Yes,
you crowed very early.
Coming, yep.
We got 2 months left.
Mm-hmm.
I think it was something like 32 trading days maybe. We can check that, I'm sure, pretty easily. But yeah, sitting pretty. Feels good.
So Drew's everything portfolio is up 19%, driven by NVIDIA. Up 41%. Jensen Huang did a bit of a presentation overnight, and Uber then wrote on the back of that and said, we're going to have 100,000 robo-taxis as a result of and using NVIDIA chips.
Yep.
That's how easy it is. You just use NVIDIA and you have anything that you want.
Exactly.
This is the best one portfolio, aptly named by Monique Pizzika, our podcast manager here at Rask.
No longer the best one.
Is up 17.72%. Yeah, but I think, just in general, like it's got the vibes. So
that's what it's about. You sound like, what's his name? Dennis?
RPM Global. You mean Barstool Sports?
No. What's his name from the castle?
Oh, I thought you were going to say
Domino,
Jim Cramer or something. It's the vibes.
It's the vibes.
Dizzy Rascals is the community portfolio, up 13.7%. Mater Group leading in charge, followed by ASML. Kev Tui's KKR Special is down 23% for the year, but we have faith. KKR could come raging back, you know.
Yeah, I mean,
I actually don't know what's going wrong with it.
Global private credit is feeling a lot of negative sentiment at the moment. Just for that one, what was it? First Brand, something, the company that was doing consumer trade, something like that, where a lot of it
something to do with
disappeared.
Something happened, and therefore,
which has hurt sentiment towards the entire sector. It's not KKR; it's everyone in private equity has been hurt in the last kind of 3-4 months.
Why don't we ask ChatGPT? Why is KKR stock down this year? Question mark. Let's see what it says.
It's something like First Brands. Yeah, it was
just
right.
giving me the stock
Possible
price.
Fraudulent or otherwise improper
Weak
activity.
investor sentiment around private equity realizations. There you go, Drew. Macroeconomic market headwinds, analyst valuation uncertainty, deal-specific structural concerns. KKR pulled out of the rescue deal for Thames Water in the UK in 2025. Okay, so basically absolutely nothing.
But there was a company that was similar to Greensill. You know how they were selling trade finance?
Mm-hmm.
Or
yes.
First Brands, which is an auto parts provider, it's basically gone bankrupt, losing disclosed liability between 10 and 50 billion against assets of 1 to 10 billion.
Okay.
And a lot of private credit managers were in this. Not to the extent that KKR should fall 20% or 40% from where it was, but more so sentiment towards, as you said, realizations, but also returns in private credit for a very short period of time. It just shows you what it's like investing on listed markets, why you want to be private markets.
Private markets.
If you're in the KKR fund, you're doing better than you would be if you're in the KKR stock, at least in this short period of time anyway.
So every year except for 2008 has been a positive revenue year for KKR. I don't know, you have negative revenue, maybe for losses. But KKR...
Is that ChatGPT?
This is actually now Ticker Terminal, which is normally decent.
Negative net income?
So... But KKR is a global private equity business, for people that don't know, one of the biggest in the world.
Yeah.
And it makes a lot of its money through realizing private equity deals, which typically have a 5 to 7 year lockup.
Yep.
So a deal that a private equity company might do.
Takes management fees and then performance fees.
And then out the other end, they don't actually get the cash until year 5 or year 7 when they sell out or they IPO a company or sell it to someone else.
Similar to a portion of Macquarie as well.
Yeah. So generally, private equity companies of this size are millionaire factories because the people that work there become millionaires, not so much the shareholders. But interesting business nonetheless. We could probably get Kev too on the show to do a bit of an update.
Yeah. Get him under pressure.
KKR year in review. Now, it's interesting that we did ask ChatGPT for an update on KKR because I've got a question here. Will AI replace Drew?
Who sent this question in?
No, this is me.
Oh, it's you. This is an Andrew Derrimouth question, I believe.
Will AI replace Drew?
No, never.
So will AI replace...
It's probably complimented me
How
in
do you
many
describe
ways.
what you do, by the way? Like, if someone was like, what do you do? What do you say? What's your first response? Financial advisor?
Yeah, I think my general response is I run a financial advice business. And then...
What comes next?
Yeah. And as part of that, I do a lot of content. So talk a lot, make a lot of dad jokes. But basically we do a lot of content to help educate people. Podcast, YouTube.
And so then the question then becomes, will AI replace any of those things, do you think?
So far, I mean, I'm sure it will replace parts of it. We met a firm yesterday as part of the financial advice business where AI doesn't necessarily replace, but helps become more efficient in a lot of sectors, in a lot of parts of your business. So I think there's still, no matter what we see and no matter how good technology is, there's still the personal touch that comes with financial advice. I could send you an AI-produced presentation that has all the information you need, but delivering that in person and going through those and explaining how they actually work and reading the nuance in the room. When you speak to someone, you can tell which parts that they're comfortable or uncomfortable or need more explanation. But an AI bot at this or a PowerPoint presentation, it just cannot do that. So
yeah, it can't.
I don't think that personal touch for any type of advice is going to be replaced. But automating investing, accumulation, a lot of those areas I think a lot of people don't need the personal touch. They just want to make sure they're on the right track.
For sure.
And those parts can, for sure.
Yeah.
But then show notes, preparing article ideas, coming up with things like that, of course.
Yeah.
AI just makes, fits more into what can already be a crazy day.
I was
Will
up
it
at
replace you?
3:30 a.m. this morning. AI got me, bro. I'm clear.
Are you playing on AI?
No, I was up at like 3:30 this morning and just thinking about things as you do at 3:30 in the morning. And I was listening to Bloomberg, as you do at 3:30 in the morning. What else are you going to do? I was reading that and something about the Ukraine.
2 hours before the close.
Amazon targets as many as 30,000 corporate job cuts. That was the reporting yesterday.
Yeah.
But then this morning, when I was listening to Bloomberg, the actual number that they are letting go of is 14,000 employees at Amazon are being let go.
Generally middle management.
All of the news sources were like AIs, like Amazon layoffs.
Yeah.
No, that's just an excuse. They overhired years ago, probably. Yeah. And sure, AI might replace some of their roles, but I think there's a lot of fear around at the moment. That's why I asked you the question. So
tends to be a lot of middle management though, which is not great if you're in middle management, but that tends to be where efficiency gains come from. You're seeing it in funds management at the moment too. And it's not AI doing that. It's probably overhiring and not having too many people in sales or face-to-face sales jobs.
It was interesting because they had the Deutsche Bank guru on Bloomberg to comment on this Amazon change. And he was like,
I feel like you have to have a shower after you watch Bloomberg sometimes. 14,000,
either that or something else. 14,000 job cuts. And he was like, every month there's about 1 million people that go through job change in the US.
Yeah.
So he's like, 14,000? No.
Yeah. Obviously bad for those people, but this is a massive, fast-moving market over there.
Yeah. So my next question for you was going to be, what's your highest conviction stock idea right now, Drew?
Wise? No, I'm not going to.
Oh, Wisetech.
I'm not going to go there. My highest conviction stock, this is a really tough one. Can it be an ETF? No, it can't be an ETF.
We're going to get that second. But what's
all right. Let me pause.
Well, I've got the next question, which we could do 2 in 1. So you could do 2 in 1. What's your favorite business right now?
My favorite business right now?
Yeah.
And it's dragging your portfolio down, but healthcare in Australia.
Okay. Anyone in particular within that?
The ones I would be buying at the moment are the ones that haven't performed particularly well. I haven't looked enough at CSL, but I still like ResMed as a long-term play. And a lot of the other, like if I was buying from nothing today, is that what you mean? Like if I was buying, had $0 in it, wasn't invested, and had to buy it today, so it's reasonable value and it's going to grow, I'd go ResMed at the moment.
ResMed.
When I go through the ASX. And then I might even say Tesla in.
Yeah, that's fair.
After Cathy Wood, on a 10, 15-year view.
After Cathy Wood, she's infected you. Yeah. That's cool. Yeah, so...
which is a bit out there.
I think I did buy, for disclosure, we don't normally talk about investments that we've made within a few days of content going to air, but by the time this goes to air, it should be fine. So yesterday, for the time of recording, I bought Wisetech shares. They were down 14 or 15%.
Yep.
Just a small amount. I already had a small amount, and I just thought, well, yeah. So this is one of the big news stories this week is Wisetech is, like, the share price has crashed out.
Yeah.
It's fallen a long way since I made a $10,000 bet against Trav from money of mine, who I said that it would probably be ASX 10 by 2030. I still hold that view.
Yeah, it's still 5 years.
Yeah, and people on social media are giving me the eyes and whatever.
We're used to those.
Yeah, but interestingly, I think that a lot of the issues that are being raised right now, it's outside of my understanding of what happened and whatever, but allegedly, well, the news is reporting that the headquarters of Wisetech was quote unquote raided by the Australian Federal Police and ASIC.
Yeah.
And it's alleged insider trading.
Yeah.
I don't think it's just for the founder, but also some of the
other shareholders,
employees.
It's hard to see in an ASX 20. ASX 20?
Yep.
Yeah. In an ASX 20 company, the trading rules on stocks are pretty abundantly clear.
Yeah.
About when you can and can't trade. There's blackout periods. There's all kinds of risk controls and reporting. It's very like that. To send the share price down 15%, I think it's just reading the sentiment that all these other things have kind of built up, and investors, like that incremental investors disappeared. And now the governance investors. So I think Aware Super came out overnight. Australian Super sold out completely a few months ago. So all those governance issues are starting to build up. And that's got to be, people are just like, I'm over it, done. But this was one that I think I'm thinking about catching this falling knife.
Really?
Yep. I sent you a knife emoji this morning.
You did.
Without context. Which I
thought I was fearing for my safety.
This is like, there's and CSL, interesting, CSL dropped exactly the same amount on the same day. I think it was 15.9%. They both fell in the same session. Two incredibly high quality companies suffering really difficult periods.
Whoa. Don't be putting CSL in the same.
Oh, come on.
Don't be putting CSL
Australian
in the
leader.
same basket as my Wisetech.
Australian leaders.
Get off it. I was thinking about this.
This sounds like a bet.
I was thinking about this. Even blind Freddie could have seen that CSL was going to fall.
It had already fallen significantly, but another 15%.
It's a dog, mate.
It's still making more profit than 2/3 of the ASX. It's growing consistently. It's still it's downgraded profit to 4 to 7%.
Mate.
Growth compared to.
At what point does CSL become sellable?
Selling a falling knife versus buying a falling knife?
Well, so I know that a lot of your clients would have held CSL since before it was invented.
They bought it $2 a share.
Yeah, and it's now 8,000 million or whatever it is. But
in the 200s still, isn't it?
Yeah, maybe. Let's just quickly bring that up on the old...
$177.
$177 is CSL share price, down from...
It did have a share split too.
$308. So it's down
nearly half.
38% in a year, 39% in a year. Jesus. So we'll get to the news on both of these companies a bit more in a second. Yep. But we've talked about this a lot on the show. I think this is probably the one stock where you and I probably disagree on most, I would say. Because CSL has been gearing up its balance sheet like you wouldn't believe for over 5 years now.
Yeah.
And that tells you when a business starts to replace equity with debt, it's telling you that it's trying to financially engineer growth. Most companies...
Investing a lot in R&D, probably the biggest R&D investor in the country.
True. Most companies go through, the most common life cycle that they go through is operating leverage, financial leverage.
Yeah.
So Apple went through this 10 years ago under Steve Cook. They started to gear up their balance sheet because they could get two. Yeah, that's the one. Not Steve Cook. I'm mixing my toesies here.
They wear the same clothes.
Yeah. So he's now outgoing as well, by the way.
Is he outgoing CEO?
Yes, I believe so. Can you fact check that?
Yeah.
You pull that up. Jamie, can you pull that up? So my point is CSL started to leverage its balance sheet like 5 years ago when it could get like 2 or 3% bonds in the market.
Not leaving Apple anytime soon.
Oh, really?
Yeah.
Oh, okay, there you go. I thought he was. And what happens is eventually once your company gears up its balance sheet too much, the true economics look good. So a telltale sign of this for anyone that wants to understand the life cycle of a company better is look at the incentives that are set for CEOs, in particular new CEOs that come into a business. What they'll do is they'll pivot the business from like earnings per share growth or some other type of growth metric, and they'll go, now we're focusing on return on equity. And when they do that, what they're subtly hinting at is that you can just use debt, which isn't captured by return on equity. And therefore, your return on equity looks fantastic because you can just put more debt in and pay dividends. And therefore, I think that I think CSL is a good business. I don't think it's going out of business, but it is a mature business. And
you think CSL is going bankrupt?
No, I said it's not. And it doesn't deserve to be on any type of growth multiple anymore.
It's back on 18 times. You're telling me CSL at 18 times, growing profit 1 year at 5 to 7%, and probably the next year at 10 to 12%.
I think it's investable.
Doesn't justify.
But I don't think
the same.
I don't think it's going to be market-beating return.
CBA trades on a high multiple.
So there's an argument to be had here, Drew, because CSL could increase the price of blood plasma, like in its vaccines business.
Like you do in a tech company.
Yeah, it could increase the price. They're life-saving products. They could pay less to donors to get the plasma and the bloods that they need in the United States. So they do have pricing power. But CBA is basically, it's guaranteed to be profitable. It has to be. Otherwise, the regulator wouldn't accept CBA not being profitable.
Yeah.
Two different businesses. But let's run, you can't see my screen, but everyone that's watching can. Let's do a quick valuation of CSL, right? I'm going to prompt you to do it. So Drew's CSL valuation, we'll call it. Let's bring it up here on the ticker terminal. That's tikr.com/Rask if you want to get a discount. So Drew, how much do you expect revenues to grow at CSL through 2029? As a reminder, we're in 2025. CSL revenues have grown at 5% over the past year, 14% over the past 3 years, and 11% over the last 10 years.
8 to 9%.
Okay, 8.5%. 8.5% per annum growth.
Oh, this is a good test.
What do you expect the operating margins of CSL to average through that period? Historically, over the past year, it's been 29%, 3 years, 26%, 10 years, 27.5%.
I think we can sit safely around, let's just say 25. Let's be
a bit more conservative.
Yeah.
What do you think the PE ratio, or PE multiple, will be when you sell the stock at the end or midway through 2028?
Not 18.
So
historically,
over the last year, it's 23. Over the last 5 years, it's 32.5. Over 10 years, it's 32.
27.
27. It's currently, according to the ticker
18.
terminal, on a 16 times forward multiple.
Yeah.
So you're saying it's going to bounce back.
It's going to trade the same multiple as CBA.
Interesting. Well, according to your valuation, the target price for CSL shares would be in US dollar terms, which is not great, so apologies for that, but it's in US dollar terms, is $226 versus $116 currently. So you're looking at an annualized return, according to your valuation, Drew, of 28% per annum.
That's solid.
Over the next 3 years.
That's a screaming buy.
That's in terms of an IRR, an internal rate of return. If a company was offering you 28% returns,
from this point,
you would take it in this market.
But the thing is, don't know when earnings and now sentiment's turned against the company. Now, when earnings have been downgraded, so their profit growth, they still expect to grow profit, but just in single figures, not double figures, double digits, which they were updating last year. Mm-hmm. But the problem with this is these bad news don't usually disappear. It started about 3 months ago. The first announcement came out. They were struggling. They were trying to cut costs. A couple of their projects, their R&D projects, weren't going as well as expected. And now it's pivoted towards, all right, now our earnings going down. We're having lower vaccination. So it's like all the parts of their business are now in a
and they're not selling that part off anymore.
Now they're holding on to it. Now they're focusing on cost cutting.
Seqirus.
Yep.
Seqirus.
Yep. And vaccines. I think the big one was vaccine in
Numbers
the
are
US
down.
was down 10%,
Which
which
you'd
is
expect.
massive
Which you'd expect though.
because we're not.
Flu season, we're not jabbing for each and every other thing. Like how
And
many
10% on
how many
previous years.
people in Australia this year have got the flu? Like insane numbers. Is
Yeah, I
that
got the
just
jab.
me?
Did everyone not get the jab or?
I don't think I did. But
think you did.
so in
I
our
don't
office,
remember if someone
so
put a
the
needle.
Rask HQ, glorious Rask HQ, I estimate that we've lost over 2.5 months of people hours from people getting sick with the flu or some sort of something or other.
It was like it was
It's been
incredibly
brutal.
bad. Yeah.
I think people have totally forgotten to get vaccinated for the flu.
I haven't seen it worse. Like people came back after 2 weeks and were still sick.
I got flu A, and one of our clients is a doctor, and he's like, that's the bad one.
This
I'm
is
like,
when
I felt
me and
like I
Mitch
was on
thought you
death's
weren't talking. You just ghosted us. We went,
remember
Owen
the podcast.
stopped talking to us.
I literally
We're just
couldn't-
running
I
it
couldn't-
without him.
I
It's fine.
I was horizontal for 2 weeks. Like I could not get up. Like it was so bad. But that makes sense. Like
So
a
go
lot
get
of
your flu
people-
jab.
Go get your flu jab.
Support CSL.
Do it.
I mean, it's too late now, obviously, but next season, get your flu jab.
Get your flu jab.
And boost CSL's earnings.
Let's jump.
Prove me right.
Let's jump into Misery Loves Company. Wisetech Global.
I think I'll put that in my portfolio next year.
Wisetech.
No, CSL.
Okay. Oh, we are coming with a big stock market game in the new calendar year. It's currently under development, and
I'm excited.
we are looking to launch a game. None of the details have been released, but every single person that listens to this podcast will want to submit their portfolio, fake portfolio, to the game because there will be prizes, which I can't confirm yet because some of the prizes haven't been confirmed either. So I did a. Why is my ticket terminal all in US dollars all of a sudden? Okay. So I did the valuation by the avocado dip on Wisetech recently. You might remember this. We talked about it. Let's have a look what the valuation was recently. So the valuation was effectively US 107, so 160, implying 36% annualized returns. Now, we talk a lot about valuations, and these are just quick back-of-the-envelope type stuff, but ticker does make it easy. Would you buy Wisetech at these prices? $71.
This is the first time I've looked at it seriously since we've been gas bagging on this podcast.
Okay.
And if you look at the chart over that period, it's been very difficult to buy because every time it's dipped, it's come back even quicker.
Yep.
And I try and fight that falling knife. So this could be, and I will confirm when I bought, this could be one of those falling knife situations where it goes well. Or it could just be a precursor to more losses for those people who listen to my stock ideas.
Actually, your platinum bet, which is coming up next week or the week after, might actually be beating my Magellan bet.
Luck or skill?
Well, skill. So Wisetech, as we alluded to earlier on, as in the reported by the AFR/Fairfax, ASIC raid has Wisetech investors furious over huge share sales. I think, based on my quick understanding, is that insiders have sold something to the tune of $2 billion worth of shares.
Yeah.
Now, this is all it's all in a state of flux.
But they always go track down the people who hate the company to get quotes when something like this happens.
Oh, absolutely.
People who haven't held it, people who wish they held it for 3 or 4 years, and it's always confirming the negative sentiment towards the company.
The crazy thing is none of this stuff would have happened had the Fairfax and all those journalists not run a huge campaign against Richard White and Wisetech. Now, whatever he does in his own time is not my business, and maybe it's fair enough that people would have aired that. But also, crucially, when you invest in Wisetech shares, you don't invest in Richard White.
Yeah.
So that's important to understand. You're investing in the business.
Yeah.
And as we've heard many times before on this podcast from famous investors overseas, is you're buying the business, and if you have a choice to back the horse or the jockey, you typically back the horse more often. But
it can,
I think
the
that's
CEO
the case
can
here.
heevily impact on sentiment because he's the face to shareholders. He's the one that industry super funds are talking to, looking at. He's the one that fund managers are looking at. So it can obviously impact on sentiment, and these are the people that are putting buys and sells on your stock in a large way too. So that's why half the CEO job is marketing and relationship management. Yeah,
it's Elon Tusk.
Yeah.
I'm going to quote from the Fin Review. In August, Wisetech reported an annual revenue increase of 14% to US $778 million or $1.2 billion in Australian pesos, slightly below market expectations. It said revenue would rise 80% next year, reaching US $1.4 billion, thanks to its $2.1 billion US acquisition of rival E2 Open. So this is the biggest acquisition that Wisetech has ever done. And I was commenting on the Rask community last night, which is free, community.rask.com.au. Come along and have a chat. A few of us were talking about this sell-off, and the E2 acquisition is a massive one.
Yeah.
And it's really unfortunate that all this other stuff is happening at the same time as they're trying to bed
You're
down
getting
this
it at a
acquisition.
discount now.
Well, yeah, you are. The same. So if they could achieve...
But in my understanding,
billion
ASIC
US.
doesn't punish the company. Will it fine the company for insider trading of directors?
Only if they breach the director obligations.
Yeah.
That's my understanding, is they would only be able to...
Personally liable. The directors be personally liable for these issues.
Yeah.
So what impact does it have on the day-to-day running of the company?
Not much.
Does the company need Richard White to run it?
No.
I think they're the questions that matter at the moment.
3.2 billion is what their estimated revenue is according to this analyst forecast. So 3.2 billion Australian clams on a market cap of 23 billion. So it's trading on about 10 times sales, next year's sales, right? If you took that as over time, what does that look like in comparison to like what they've done historically? It's the lowest the company has traded on a relative valuation basis since 2020.
Yeah.
And you're buying it, in effect, you'll probably be buying it at its lowest price to sales ratio since it listed on the stock exchange.
Yeah.
So what you're effectively saying is the company is now worth substantially less. The sales that it has is worth substantially less than when it listed. Now, obviously, everyone, I'm super conflicted because I own shares and I said publicly that I bought shares.
And you like the company.
But I like the company. I think that I don't want to be an ASX listed CEO. But if I was going to be one, I'd want to be one of a company that has like 99% retention, sells software, has a global marketplace, is run by software engineers and developers, and has the leading product in the world.
Oh, Wisetech Global.
Wisetech, yeah. Maybe ResMed would be another one that you could say that for. But I think that balance of probabilities, it's interesting.
Yeah.
So that's why I bought a little yesterday.
Yeah, I'm going to do a bit of a deep dive over the long weekend and make a decision by next week.
We're Melburnians, so every second weekend is a long weekend.
Yeah.
But anyway, we got the Melbourne Cup. So my tip for the race is Wisetech.
and a rate cut.
Domino's
No
also
rate cut,
pumping Domino's. Sorry, not Domino's. AFR pumping Domino's pizza shares. Drew,
Yes.
I don't know if you saw this.
I didn't know Jack Cohen was CEO of Domino's now.
I did not know that either. So Domino's Pizza allegedly was supposed to receive a takeover offer
from Bain Capital, the group that also bought Virgin.
Yep.
Several years ago.
Domino's Pizza shares are down from 162 to an honourable 16 in 4 years. Very powerful major shareholder though, by the way.
162 to 16.
Yeah, it's down, what's that, 90% from its peak.
When did that happen?
Oh, just since everyone realised it's Domino's Pizza.
Since the end of the lockdown.
Since they went, remember Joe Aston wrote a big article about this? I don't know if you remember this. He wrote about it in the Chairman's Lounge as well, his book.
Is that a falling knife? Can I buy this one too?
I'll summarise Joe's take on this. You're selling Domino's to the Italians?
It didn't make sense. I mean, Domino's, yeah. I mean, I was a big fan of the $8 pizzas during, end of high school, early university days. But yeah, no offense, Domino's, but a massive takeover bid.
Pizzas have got better.
But again, this is a falling knife story all over again. Whether it's true or not, for those people who had it over $100, you're sitting on 85%, 90% losses, and then you're potentially getting bought out, and all that loss that you hoped, you anchored to a higher level is just going to disappear. This happens so often with these companies. Hopefully not with something like CSL, but this is why when things change and earnings downgrades and all these issues consistently come up, it's sometimes better just cut your losses and buy something that isn't falling. Yeah, buy something that goes up.
Turn around, seldom turn. Matt Joss from Maven Funds actually had a fantastic post about this not too long ago. It was like 5 years ago. I'm sure my age. I'm sure you can go back and Google Matt Joss Maven Funds tipping point or something like this. And he talked about how if you're going to buy a turnaround, wait until it starts to turn.
Yeah.
Typically, because it de-risks the maneuver.
You're not going to miss much.
Even if you give up some of the early upside, wait for it to turn.
Particularly for an individual stock.
Domino's Pizza Incorporated, which is the head Domino's business in the United States, that's basically flat over the past 5 years. It's up 8%.
But Domino's huge in the US.
No. But like, no. Okay, so it's a sell. But I guess my question is like, does it at any point become interesting?
I think it's just an incredibly difficult sector. You look at like Guzman y Gomez, you look at all the fast food chains, and Collins Foods going well at the moment, but it had a very difficult period for the 3 to 4 years before that. They feel like they go in trends, and like at the moment, roast chicken is where all the private equity money is going, and scaling up roast chicken shops. Could be fish and chip shops next, who knows? And they're very secular. Cyclical. And I just don't like. It's hard.
We're recording at 8 a.m., which is not normal for us. We're normally in bed by now.
It's hard to it's very hard to predict. Like Domino's goes out of all these companies can go out of style very quickly, and they have to keep evolving to keep growing. And I'll run a cyclical company for a short period of time, but in these days I want to buy something that I don't have to touch, and I can't see that being one.
It's interesting, isn't it? Like Domino's has gone from 2012 until, according to the ticker terminal, I've got it here,
exceptional run.
$2.3 billion of revenue is what it does now, but it was at 180 in 2013.
Yeah.
So it has like more than 10x'd its revenue in 10 years.
And the share price has gone nowhere.
Its share price did go up for a bit, and then obviously it's come right back down.
I did not know it was that low. That's how much attention I pay. I got an over-under for you too.
Wait, just quickly though. You mentioned Guzman y Gomez there. I would be much more inclined to buy them over something like Domino's because they own the brand. So this was what I was going to say before. Is like Domino's in Australia, for people that don't know, ticker symbol DMP, this is the master franchisor of the Domino's brand in the United States.
Yeah.
It was like people who used to buy Coca-Cola Amatil shares, which was the Coca-Cola business in Australia and Indonesia.
Yeah.
When Coca-Cola Company is the one in the US, that's got all the brand and it owns all the intellectual property. In these types of fast fashion, consumer-facing businesses, I always opt for the business that has the brand.
Yeah.
Collins Foods is
like
probably
Chipotle.
a slight standout in this case. I might just bring up the Collins
They
Foods
just add
share
new
price.
verticals, or one of them performs well, one of them struggles. KFC's making a comeback. But then again, you're kind of driven by global KFC, aren't you, as to what you can do locally and domestically with your KFC
That's the
business.
point, right?
You can't just create your own chicken meal.
The Collins Foods is up 400% since 2011. It's paid good divvies along the way.
Can you buy shares in Red Rooster?
Who even owns Red Rooster? Does anyone even goes there? Yeah, I wouldn't buy. I would be interested in Domino's, but it's not like a
lot of people swear by Red Rooster.
It's a turnaround, is what I would say. What's your over and under quickly? Over
and under, the number of companies in the ASX 200 that have more than doubled so far in 2025. The number is 10.
More. Did you say doubled?
Yeah, 15.
Okay. Yeah.
Over under 15.
Oh, under.
Over. 19 companies have delivered returns above 100% year to date from the ASX 200.
Wowza.
Massive. Like that's pretty substantial. Like you're talking about reasonably big size companies that have done 100% returns. One led by Drone Shield. We can talk about.
Yeah,
that's a different. We get a lot of questions about Drone Shield coming through.
Yeah,
there's some gold miners in there. There's Codan. I've heard that company talked about every year for the last 10 years. Like the beep. What do you call it? Metal detector company and batteries. There's like 4 gold miners in there. There's some rare earth companies. Megaport's up 100%, but not Generation Development. So the owner of Lonsec, the owner of Generation Life.
Yep. Grant Hackett.
It's 19 companies up.
Hacky
so
boy.
10% of the index is up more than 100%.
Yeah.
That's pretty crazy.
Some interesting companies that you just mentioned.
Capricorn, Oztal, Parenti.
Defense
which
businesses.
Which also leads to, did you see the article in the Fin this week?
Would you buy, which of those companies would you buy?
Oh, a lot of them trade on massive, Life 360's in there as well. Which companies in there would I buy? I'd probably be more comfortable investing in a resource company that's gone up 100%. So maybe I'd be looking at Liontown with no conviction whatsoever.
You wouldn't pick,
I mean, it's 100%.
You wouldn't pick Gen Life, that Generation Development Group?
Not at the moment. Have you seen
the
multiple on that thing?
The valuation is outrageous.
Like
I don't know how you can spend 18 times on a private
63 times.
business and then somehow turn that into something. Anyway, separate conversation.
Different thing. Love the company, but buying shares in it, like love the business that they have, but buying shares in it, very, very challenging. At the moment, at least. I know you interviewed Grant Hackett, who's CEO of GDG now.
Yeah, he is.
Yeah.
He got promoted.
Yeah.
Caught up with Felipe not too long ago. Shout out to Felipe.
Lovely guy.
Yeah, great guy.
The other one I had come up was Global X released like the most popular themes of the year. Mm-hmm. I thought that was super interesting. We covered in the retirement podcast. We'll come up in the next few weeks.
Yep.
But it was super interesting to see that it wasn't just AI. Like you feel like everything AI would have been going up, going like crazy. But there were two themes, and I find them very difficult to sometimes justify investing into. And I think they're very lightning rod like themes. So defense, military spending, and uranium. So efficient energy production were the two biggest themes according to Global X after gold, and so just after that was gold miners, and they were both up significantly for the year, like in the 50 to 60% for an ETF.
Yeah, the defense stocks have really, up until recently, they did really, really well.
Yeah.
I think Vlad had call options on all of them.
Turning around, and then he started shorting.
Yeah, then he was like, nah, actually.
But it's...
Yeah, in uranium,
really
interesting, thematic. Not much substance to it when people invest in it. But did you see, I don't know if you saw the news this week, that Microsoft announced that they're basically doing a huge offtake agreement to stand up a nuclear power plant that was in the... I think it's going to be decommissioned.
It's so easy to do other things and batteries and all these other things, but we're going back to nuclear. You know who called this though? Do you remember your Rask event at the State Library?
Yeah.
You know who said they'd invest in uranium?
Lee Matthews. AFL great, Lee Matthews.
Calls it. 3 years ahead, but called it. People, this is what, for anyone who listens, I have a really weird memory of like the most niche, unique facts that I remember from certain things. And it was Lee Matthews saying if there was one sector interviewed by the Equity Mates boys, if there was one sector he'd be invested in, it'd be uranium. And I think we laughed it off, but God, he was right.
Yeah, he was. Every time I just search for Lee Matthews, it's always like Lee Matthews snaps a point pose. Lee Matthews, big hit. Lee Matthews kicks the snag.
Lee Matthews, uranium.
Yeah. That's what I'm trying to find. It's not working.
I wonder if he was loaded up on it.
Lee Matthews is the AFL great, probably one of the, if not the greatest player, one of the greatest players of all time.
And coach.
One of the greatest coaches of all time. It was hilarious. I remember when he said that on stage, everyone was like, this guy's crazy. Yeah. And now look at him. Lee's retired once over again. What's the best way to play uranium? With the Global X? Because they got the uranium
I find ETF, the thing is, I think my issue is I've got one of the biases where I was incredibly badly burnt owning Paladin.
URNM, Global Uranium ETF.
I think owning Paladin, when it went from 10 to 10 cents, has burnt me from uranium for a while. And that was a company that wasn't producing. It was constantly under corporate pressure. It had loans, it had debts. Mm-hmm. No one was buying uranium. That was after Fukushima and the nuclear reactor and the earthquake in Japan.
There's a lot going on.
And everything's changed. Apparently changed since, but I still like, and whenever it comes to these themes, there's enough data out there that can show you that this is the best theme to be invested into. There's going to be a shortage of uranium and all those sort of things. But I think the best way is either by the commodity price, so you're not getting any leverage, you're just getting the commodity, or I'd do a bucket. Not that I'm recommending this. Would not personally invest in uranium, but then go buy a bucket of all the uranium companies. As opposed to trying to pick which uranium company is better.
I think I actually just found the thing that you're talking about. the line. Let's see, because I'm going to play this through my computer. Let's see if everyone can pick it up here. This was Lee Matthews being interviewed at a Rask event by Equity Mates.
By Bryson Wren.
Let's see if it comes up. So I'll just click play on this. I don't know if it will work, Drew.
About a sector. Okay. Logic tells me that we know that there's this hope that renewables are going to power the world over this next generation. Okay. Maybe they will, but it might be that you need something else. And maybe for all its potential downsides, that nuclear might well be the base load alternative. It seems logical to me to think about. Anyway, that's maybe something in the uranium or the energy or the nuclear energy sector might be my pun.
No. When was that? What day was that?
This
That was
was
amazing. Sorry, guys. It is 8 a.m.
this is December
on a
9th,
Wednesday.
2022.
2022.
So Lee Matthews, the AFL grade, picked uranium. How's it looking?
Well, it's doubled. The ETF wasn't. December 22.
Yeah, 2022.
Yeah, it's basically doubled since then. So it's done all right. I mean, it's no 10 bag, Ali, but
Currently. It's not brown.
That's good call. Good call. I don't know. I mean, the premise being that renewables won't work, so we've got to use uranium. It's kind of gone different to that. He didn't predict the AI boom, the data centers, and everyone needing efficient energy closer to where they are.
There's the beta shares ETF. I think this is the URNM is.
There's a global one as well. But one of the issues I've seen with these
In
is
3 years, it's compounded at 25% per annum.
And the uranium, sometimes the uranium ETF gets too big within the market and starts moving the market, which becomes the Sprott uranium ETF overseas.
Yeah, because there's not enough volume in the underlying market, right?
Yeah, exactly.
Oh, so Globalex has got the Atom ETF. How long's that thing been going for? It's got 100 mil invested.
After Lee mentioned it, probably.
Yeah, they probably took the idea from Lee.
75% this year.
Atom ETF. So 5 years, Atom ETF is up from. So basically, when Lee picked it, it would have been $9.70. It's now $26. So it's nearly 3x.
It's tripled, yeah.
Jeez, Lee.
Credit to Lee.
Get Lee back on the show.
Let's go.
Watch one of the big fund managers like, hey, Lee, you want to be a portfolio manager? You got
good macro calls. Macro
fund. You're not the first person that's run a Brownlow to do it. Anyway.
That was amazing.
Anyway, shouldn't say that, but I did.
Guy Debelle came out this week. I thought that was pretty interesting too. He had a really good article on private credit. I thought that was really, if anyone, maybe we'll put it in the show notes. Guy Debelle, number 2 at the RBA, was never head of the RBA.
Yeah.
And taught under Bill Mitchell, the
Honourable.
Yeah, modern monetary theory.
Obviously, everyone knows Bill Mitchell from his time on the Rask podcast.
Yes, of course.
Yep.
One of the biggest the biggest video until recently that Wattle ever had was like Bill Mitchell, 25,000 views or something, talking about MMT. But he was basically talking about there's so much focus on the private credit sector. There was an article today about Latrobe starting to see net outflows. So redemptions increase above just in the last 2 months.
Whoa. But that could be cherry picking because Latrobe just had all those issues.
Yeah, of course it is. It's like 2 months of data. It was, but of course on the front page of the paper because they're
just
trying to
cherry picking
trying to get clicks. Yeah, exactly. But significant inflow still, but just increasing withdrawals, and people could have already had that planned anyway. But they were basically talking about Guy Debelle is being broadly positive on the role of the private credit sector, and just opening up to the idea that one of the problems here flagged, which we all know, is that too much of private credit is in property. But he also highlighted the fact that you're getting a higher return in private credit to offset the fact that some of these loans will at some point go bankrupt.
Yeah.
And this is exactly what the regulator wanted. They wanted more loans coming out of banks, which are highly leveraged institutions. They have like 4% capital for the loans that they have, into non-leveraged institutions in the form of non-bank lenders.
Yeah.
So he was very positive on it and just talking about the industry, but why there probably needs to be more of a focus on, like what we do, like the Invesco podcast I talked about, where they're investing into essentially corporates and doing corporate private lending or corporate lending as opposed to property-backed private lending.
Which is what most people go globally for.
Yeah, exactly.
Because people are going to shoot me down for this. There's not that much of a mid-market private credit market here in Australia, as far as I'm aware.
And not very accessible either.
No. Whereas in the US, you could lend money to Hungry Jacks. That would be the type of business that takes your loan in private credit. Or like any of those massive businesses that in Australia, if they were on the stock exchange, they'd be in the top 20. That's the type of business that gets the loan in the US. Now, we do have to get to some questions, Drew. We've got some great ones here, which we'll limit ourselves to 1 minute responses. If you do send your question in, send it in via the link in your podcast player. Select the Australian Investors Podcast, and Drew and I will gobble it up. Remember that if you do send any questions, send it with a funny name. But secondly, anything that we do answer here on the podcast is strictly general in nature. We don't know your needs, goals, or objectives. So before you act on the information, speak to a licensed and trusted financial advisor. If you don't have any idea what your needs, goals, or objectives are, you should just speak with them. If we do mention ETFs or super funds or whatever, they have a PDS or product disclosure statement, as well as a TMD, which is a relatively new document, which outlines who the kind of fund or the product or thing is designed for. It's actually really interesting. It's way more interesting than PDS, to be honest. So check that out. You can find out more about Rask at and the Rask Group at rask.com.au/FSG. First question comes from Spend Money to Make Money. If there was a significant black swan event in the future and you could only pick one stock to buy to hold for the long term, what stock would it be and why? I'll go first. Intuitive Surgical, the world's largest robotic healthcare business. It has the Da Vinci machine that can peel a grape. And it is so far ahead of any competition, it's unbelievable. And my big theory over the next 10 years, Drew, is that we've got the most amazing software in the world, but what we haven't done despite all the AI and things, is connected software to hardware as well as it should be. So robotics and automation. Yeah. And I think the future of medicine in simple surgeries, non-complex surgeries, is robotic medicine and robotic surgery. And I think that as the leader, Intuitive Surgical should have bought it years ago when I first found out about it, put it off because it was too expensive. And then I caught up with David Gardner recently and he's like, recommended Intuitive Surgical. I'm like, bruh. So I would buy Intuitive Surgical. Drew?
I think I'm going to do another one that I haven't been able to buy and stump up and hasn't fallen enough and been consistently in an uptrend and is also within the everything portfolio.
Oh.
I was leaning towards NVIDIA, but that's just boring. Pro Medicus.
You're back on the...
I don't own it. And in a black swan, I'm assuming everything falls by like 50 or 60%.
Yep.
40, 50 even. That would make it buyable for me. I think like it's one of the, as you always talk about, like with the Wisetech and Pro Medicus, a company I just keep watching but have never done anything about. Yep. And just have this scalability, this operating leverage and this potential. And then there's nothing that says that Pro Medicus can't expand into other areas at the same time, given how far ahead they are on their own technology. So
cool. I like it.
Yeah.
Knife catcher.
I could say something like Wes Farmers, but really
yeah, I'd buy Wes Farmers.
But they're just a given, aren't they?
Yeah, you'd buy that.
Macquarie Group.
Yeah, you would buy
all
that.
those sort of things.
Knife catcher. What's up with Wisetech getting rated by the AFP? Would this be the kind of opportunity I should look to buy, or is it a red flag? I think it's both. And we can't give personal advice, Knife catcher, but so much negativity. Literally the only time I'm really excited about investing, Drew, is when something really negative happens. And I'm like...
You sound like me.
What can I buy? Where's the money at? Like yesterday I had to transfer money from NAB to ING, then pay ID into Perla, then buy the shares. And I'm like, well, fortunately Perla, incredible. I don't know, just to toot Perla's horn for a second, they're a sponsor of our Finance Podcast. Crazy thing, when I did pay ID from ING to put money into my Perla brokerage account, Perla sent me a notification that the money was in my brokerage account before I got the confirmation from my ING app to say it's been sent. That's how crazy the technology is. Anyway, so I bought Wisetech yesterday. It's not for everyone, but what I realized, you get the best buying opportunities when there's the most uncertainty. Yeah. I don't have all the answers. E2, the whole AFP raid thing could be an absolute nightmare and might blow up and whatever. Position sizing, Drew.
And I think it's different when it's an earnings downgrade as opposed to market sentiment turning.
Yeah.
Like earnings downgrades are very difficult to come back from. Market sentiment like this, management changes, all those sort of things can turn this around. But we don't know, like there's two schools of thought. It's like professional investors would be, I'm not touching this. There's too much risk.
Australian
I can't explain what I'm doing.
Yeah.
And then others are like, well, I'm getting what I thought was fairly valued before at another discount of 15%. Don't worry about how far the share price come down before that, but what was the valuation at the time? So, it could be both. I'm leaning towards positive.
Yep. Alan, bonds. You're often talking about investing in bonds. I have a mortgage, and I imagine a large amount of the audience does as well. I really can't see the point of investing in bonds over adding money to an offset account and getting a similar return on investment. Or am I missing something? Thank you, Alan Bonds. Drew, bonds v offset account. Offset account, you save your interest.
Assume it's in your own personal name. One part of this kind of comes down to your tax rate. So the way I think about it is what's the after-tax cost of your debt? If you're paying 5%, it's something like 8%.
Yep.
So by putting it into the offset account, you're getting a guaranteed 8% return. And if you're buying a government bond, as you talked about with PIMCO.
Rob Mead, yeah. I think it's like 4. That episode comes out next week, by the way.
You're getting a 4.5%. Yeah. Very low risk, called the risk-free rate, but not a risk-free investment. You're getting very low risk, 4.5%. So you're basically giving up 3.5% per year. Then you obviously have to pay tax on the 4.5%. So if it's just between those alternatives, you're better off having money in growth assets or your offset account, as opposed to having low-risk assets that guarantee a return less than the after-tax cost of your debt.
I think that's a good point.
In interest rate.
You often
times
you can
1
make money
divided
from
by-
bonds beyond just the interest though as well, as we should
Yeah.
note. But for
consistent,
long-lived accumulators, the offsets are great. So final question we'll answer today comes from Everest on the Hume. Don't know what that means. Hume being the freeway? Don't know. Maybe they're up at Mount Kosciuszko. Something
Maybe.
like that.
Yeah.
Okay, let's just run with that. I feel like I'm all over the shop. Can you be too diversified? I was thinking about this morning as I was walking down to lunch at the Grain Store in Melbourne. Easily one of the best breakfast joints in Melbourne. Check it out, the Grain Store. Opens at 7 a.m. Great coffee as well. It's just, there's no infinitive. It's Grain Store. So, yes, you can. Look at the Forbes rich list. How many of them just bought Vanguard?
Or property.
None of them.
How many of them just had property?
None of them.
All of them.
There is a misconception that diversification is a free lunch and it's the only lunch. Concentration or conviction is how you move rapidly past anyone else. Whether that's in your career, you invest in specialist skills, whether it's in your investment portfolio and you have a concentrated bets that are well researched. Maybe it's a few ETFs, maybe it's something like that. That's how you get outsized returns. People are missing this. The whole point of index investing is you will get the average return. But we know that as per the conversation with David Gardner, Drew, that 4% of stocks outperform.
Yeah.
Are the only ones that add value to the stock market. There's this fantastic chart. I don't know if you've ever seen it. It shows the proportion of stocks on a stock exchange that do better than bonds. I don't know if you've ever seen that. All the index fund investors use that as justification of why you shouldn't pick stocks. They say it's like a needle in a haystack.
Yeah.
But then all the active fund managers say the exact opposite.
That's why you should.
That's why you should do it.
Every data point can be used in different ways. That's why we call them chart grams.
Yep, true.
We call this diversification. Like, it is so easy. The amount of portfolios I've seen, some advisors, some individual investors, where they have 50 different stocks in their portfolio, and they're all random kind of weightings, and none of what we want. I mean, the answer really is it depends. But yes, you can be over diversified, and the other part is what level of diversification is appropriate. If you're in retirement, you're trying to get more consistency and resilience. You want a higher level of diversification compared to if you're in accumulation and you've got time and capital to keep contributing over a long period of time. So I think, yes, you can be too diversified, and there's different ways you can do that. You can have too many stocks, you can have too many themes, you can have overlapping ETFs to do the same thing. You can be overweighting sectors or not diverse. A lot of people think I've got 4 banks, or I've got VAS and I've got IOZ. I'm diversified. I'm like, no, you just bought 2 of the same things that are giving you 40% in 2 sectors. So I worry just as much about over-diversification as I do about under-diversification.
Definitely. It's knowing the balance, right?
Yeah. And the fees that you're paying.
We've seen that, yeah. We've seen that so often with a lot of the really ultra-broad index funds.
Yeah.
They can be fantastic for people that are just starting out because you're just diversifying. You can run a simulation yourself. You can go and Google some academic literature or ask ChatGPT to get it wrong for you. And they will tell you that basically the math says that after about 30 to 50 uncorrelated investments in a portfolio, there's no benefit of diversification. So effectively, if you have assets that move in different directions, if you get to about 10 of those positions, you remove about 70% of the risk, the market risk of that portfolio. I know that's a lot of gobbledygook. This is the Australian Investors Podcast, mind you, which is for intermediate and advanced investors. But basically what I mean by that is in the stock market, there's a risk that you can never remove, which is the risk of just being invested in the market. And then there's the risk of the specific individual company or ETF or sector or theme risk. You can reduce that through diversification. You can't reduce market risk to zero. It's always present, but diversification will get you towards that.
There's a good book that one of my clients sent me, which is, I believe it's called The Axioms of Risk.
Axioms.
That actually encourages risk taking,
Axioms
but taking risk within your own parameters.
Yeah.
I'll see if I can track it down.
The Zurich
I believe
Axioms?
it's that one, but there's like
the 12 axioms.
Encourages having more concentrated portfolios and having more conviction and knowing more about it. This is the thing, that everyone has a solution or an approach to investing. All different ones can work. There isn't just one that works. It's about finding one that's suited to you and helps you deal with the emotional stress that comes with investing and volatility.
By Max Gunther.
Yeah.
The rules of risk and reward used by generations of Swiss bankers.
Yeah, always going to work.
1,000 reviews on Amazon.
Yeah.
Interesting, yeah.
I believe that's
my young son, Charlie, I want to teach him to take as much risk as he possibly can, provided that it's calculated risk, provided he knows the risk that he's taking. If he does, then take as much of it as possible.
You tell that to a toddler who's climbing up there.
Oh, mate, he's going to be riding motorbikes. He's going to be doing stunts. I don't care as long as he's aware of the risk that he's taking.
Yeah, all right.
Yeah. That's how you live life and you get better returns from it.
So,
dad joke. You can head to wattlepartners.com.au to get in touch with Drew. That's not the dad jokes. Well, you could.
Yeah.
But
I can try pretty
you'll
slow
find
on
plenty
them.
of links in the show notes for financial advice, for all different types of things. Mortgage broking, our courses, Value Investor Program is now free. Drew, what do you got?
I got fired from the calendar factory yesterday.
Oh, interesting. Why?
Because I took a couple of days off.
What? Okay, I kind of get it.
That one.
It's loose. That's not bad.
Yeah.
It's not bad.
Yeah,
I like
I'll
it.
take that. Thank you.
Well, Drew Meredith, director at Wattle Partners, host of the 5 Massive Risks for Your Retirement on YouTube, now available.
Road trip. Taking the book to Gippsland.
Taking the book to Gippsland. We are going on the road next year, 2026. We're coming out with some events. About 700 people completed a survey to tell us what days they want us to do the events. Have a guess what day everyone wants us to do?
Thursday.
Saturday.
Saturday
all day.
Yeah.
So
let's do it.
We're thinking that we might do 2 Saturday events, and then the other cities we might do.
Might get a bit rowdy on a Saturday though. I thought the midweek, Adelaide got a bit rowdy last year.
Thursday and Friday nights, I was thinking everyone's going to be well lubricated in their Hawaiian t-shirts. But this year coming, it's going to be a big year. And if we do Saturdays, we're going to make a big splash. So we're really excited by that. But
exciting.
Drew, until next week, 7 a.m. Thanks for joining me.
Good to see you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.